do you invest without losing? This is a great question, isn't it? And why is that important? Because as Warren Buffett once said, rule number 1 is never lose money. Rule number 2, don't forget rule number 1. When you first start out as an investor, it's very tempting to follow what everyone says. It's tempting to chase after the newest stock, like Uber, Airbnb, and to chase after the newest tech stocks. And they're so attractive, aren't they? Because they have like new business models, and you might think this is the greatest way to earn money. But as Warren Buffett said, the first rule is not to lose money. And so how might we be able to think of it in that way? Well, the first thing to think about is to imagine and to remember what is your margin of safety. Warren Buffett once said that these 3 words were the most important things that were ever said in the history of investing. What is your margin of safety? And if you think of margin of safety as a football team, let's imagine you are building a football team. And when you start building your football team, you might start from a front position or from the back. Well, I want to invite you to start thinking of building stocks as building a football team. And in this football team, you want to ensure that you never lose. And so how do you not lose? You first cap your downside and you build from the back. Capping your downside is about building in the stocks that are defensive in nature and help you to ensure that you will never lose. And so you might be asking, well, what kind of stocks are defensive in nature? Well, they are often stocks that are looking at industries that never change. For example, businesses in the area of food, housing, healthcare are termed defensive stocks because people will always eat food. People will always need healthcare. People will always need utilities like electricity, water, just to survive. That's why they are called defensive stocks. And so in looking at building your portfolio, it's important to start looking first at the defensive things and to build from the back rather than from the front. So the next one is to think about playing with money that you can afford to lose. Very often we are put in a difficult state where we are playing with money that we cannot afford to lose, and all of your money is tied up in illiquid stocks and equities. This is dangerous, and a better suggestion would be to ensure that you start off with ensuring that you at least have 6 months of salary before you put the rest aside for your investments. Well, the next mistake that we often make is to mistake pricing for valuation. Well, here's Michael Mauboussin, one of the greatest investment writers I've read, and he says that often multiples are not valuation, they are shorthand for the process of valuation. If you look at it this way, very often we might look at the price earnings ratio of 1. And here's an example from my personal experience. I looked at Sino-Granules, this stock based in China that was selling juices, and at that time their price earnings ratio was 3, just 3, and I thought they looked cheap. But I didn't ask myself, why are they so cheap? Within a year they had a 89% drop, and that's when I suffered my first permanent loss in losing $3,000. Very often we might mistake pricing for the process of valuation. Well, don't just look at the price earnings ratio, rather look at the 3 drivers of investment returns: the momentum, or how strongly the stock price is moving, then the value of the stock, or how cheap it is, and then the quality, how good is the stock. These three drivers of returns can be easily used with Stockopedia, which you've probably seen in the previous video about how it can be used to screen better stocks for your investment criteria. Well, secondly, we need to think about investing as buying a business, not a stock. Warren Buffett loves to say that even if tomorrow the stock market closed for 10 years, he would still be confident of buying that particular business. Very often when we start investing, we are tempted to look at the daily stock prices and stock codes. But it is not that is the most important. The most important thing is how great the business is, not how great the stock price is. And so Warren Buffett's first criteria is often he says severe change and exceptional returns usually don't mix. That's why he's often said that he doesn't touch technology because he doesn't understand it. Even though he's great friends with Bill Gates, he's never bought into Microsoft because he says that he doesn't understand it. Recently, he started adding tech stocks like Apple and Amazon, which was bought by one of his investment managers. But you can see that Warren Buffett still places a lot of emphasis on stocks that have a huge economic moat. And here's a story of my personal experience buying SATS, an airline services company that focuses on providing food to airlines, to security guards, cargo handling services. And well, if I ask myself, do I understand the business? No. Do I understand the industry? No. And if you look at the airline industry, well, it's changed massively over the past COVID-19 pandemic. And that resulted in my permanent loss of 19%. The second criteria for Warren Buffett is where he looks at a company that has a franchise that will last 25 to 30 years. And so that's why he says that great companies are those that can employ large amounts of capital at very high rates of return. My personal experience was the Hourglass, which since then has yielded 40% in returns over the past 2 years, and its returns on invested capital is about 11%, whilst its business is very easy to understand. It's just the selling of luxury watches. If you look at the fundamentals of this business, it's a great franchise because it operates in an industry that hasn't changed. For hundreds of years, people have been buying watches, and as long as people continue to buy based on the two fears, fear and greed, people will still want to wear a fancy watch. And so that industry doesn't change. And with the brand name of the Hourglass, we can see that it's there to stay. Lastly, the most important thing in ensuring that you don't lose is to prove yourself wrong. Ask yourself, why might I be wrong? Why might I be wrong? Well, in this great diagram by James Clear, he looks at the confirmation bias. Very often we are tempted to go down a confirmation bias where we look at the ways or why we might be right rather than what might prove us wrong. So for example, if you look at my example of SATS, I was telling myself that the passenger numbers were going to improve after COVID. I never thought of trying to find the real facts that proved otherwise. And if you can see here from the IATA numbers, the global RPKs, or the revenue per kilometer, was not going to increase to the heights of pre-COVID until after 2023, according to IATA forecasts. And when I started seeing this, it made sense. I had proven myself wrong. Very often when we look at this process of investing, we do not think about not losing. We think a lot about winning, but we don't think enough about not losing. When I was talking to my entrepreneur friend a few days ago, he told me that for every single business he ran, he knew that he would never lose. He would never lose. That was how sure he was. And that was because he employed a very rigid criteria. Before he went in, he was absolutely confident of what he was doing, and he never entered something that he didn't know. Today, if you are buying something, like a business or a stock, think of it as buying your own socks. Don't think of stocks as equities, of financial models. Think of it as something like your socks. Do you know what socks you wear? Similarly, do you know what business you're buying into? And with that, you start beginning to realize that there is something to buy where you will never lose.